For the first time in recent history, Canada's population actually shrank last quarter, and one analyst says this threatens the foundation of our entire economic growth model. Today, we trace what that means for global markets, your personal finances, and whether Canada itself still makes sense as a home base. Welcome to the Daily Brief, Canadian Macro Weekend Edition. I'm Steve. Today, we're following one through line, a crack forming in Canada's economic foundation, how it's ripping into global markets, what that means for your money, and what some Canadians are quietly doing about it. We heard from Steve Saretsky on Canada's demographic collapse, Eurodollar University on global recession signals, Minority Mindset on building wealth through a downturn, and Blueprint Financial on where Canadian dollars actually go furthest. Let's start at the source. Steve Saretsky covered what they're calling a dangerous economic contraction phase for Canada, and the numbers behind it are genuinely striking. The core argument is that Canada's economy is entering uncharted territory as population growth has turned negative for the first time, threatening a decade-long growth model that was almost entirely dependent on two factors: population increases and debt expansion. The headline stat, a quarterly population decline of 103,000 people on an unseasonally adjusted basis. That might sound like a rounding error in a country of 40 million, but the deeper issue is what it reveals about the engine underneath. Saretsky's analysis shows that Canada's economic growth over the past decade produced no meaningful productivity gains. It was population plus debt, full stop. Remove one of those inputs and the math stops working. Saretsky's warning is that the population growth now negative, government deficits will explode higher because debt becomes the only remaining lever to manufacture growth. That's the setup for what Saretsky calls a toxic economic environment, sectors built on continuous population-driven demand, housing, retail, and services, suddenly face a structural headwind with no easy fix. So what does that look like when it reaches global markets? Eurodollar University was tracking something this week that connects directly to Saretsky's thesis. The global flight to safety trade is accelerating, and equity markets may be telling us something that central bankers are refusing to say out loud. Their evidence starts in Europe. France is down 10% and German markets are down 11% this month. ECB officials are threatening rate hikes as soon as next week, spooked by oil prices spiking out of the Middle East conflict. But here's where it gets interesting. The TIPS market is showing zero inflation expectations despite those rising energy prices. Bond markets aren't buying the inflation story, they're pricing contraction. The oil picture makes this messier for Canada's trading partners than for Canada itself. Brent is trading $10 to $15 higher than West Texas Intermediate, with Middle Eastern spreads even wider, meaning Europe and Asia are absorbing energy costs that North America largely isn't. That divergence matters, because it weakens European consumer spending precisely when Canada needs trading partners to stay strong, and it validates the recessionary read that equity markets are already making. The broader takeaway from Eurodollar University is that markets are testing whether policy support will materialize, and growing apprehension suggests the traditional safety nets may not fire this time. That's a sobering backdrop for any Canadian investor, which brings us to the practical question: what do you actually do with your money right now? Well, Minority Mindset's message this week is simple, unsexy, and increasingly important. If inflation and recession risk are both real, the answer isn't to spend more defensively, it's to own more. Specifically, own things that appreciate and pay while you wait out the storm. Their core framework is to use income growth to buy assets, not to upgrade your lifestyle. Most people take a raise and expand spending. The wealth building move is to redirect that increase into dividend generating assets, then let the cash flow fund lifestyle expenses over time. It's a compounding play, slow at first, but then powerful. For implementation, they keep it accessible. 90 to 98% of people are better served by low-cost index ETFs than by picking individual stocks. Minority Mindset specifically mentions VTI, SPY, DIA, and SCHD. Their focus on SCHD is worth noting. It's a dividend-focused ETF that pays quarterly. At a 4% yield on $100,000, that's $4,000 of annual passive income, reinvestable to compound the base. Minority Mindset argues that the strategy works in slow growth environments because you're not depending on price appreciation. The income stream does the work. The catch, of course, is that this strategy requires capital to deploy in the first place. And in Canada right now, with stagnating wages, high costs, and a currency under pressure, building the capital base is genuinely harder than it was 5 years ago. That's exactly where Blueprint Financial's analysis becomes relevant. Blueprint Financial ran the numbers on something that's become a more serious conversation among Canadian expats: What if relocating isn't just a lifestyle choice but a financial one? Their analysis uses global peace index ratings and cost of living data to identify where Canadian dollars and Canadian sourced income go furthest. The framing matters here. If minority mindset strategy requires surplus capital to work and Canadian incomes are being compressed by tariffs, stagnant productivity, and a weakening loonie, then the arithmetic of staying in Canada starts to look different. Blueprint Financial's data shows Canada currently ranks 15th globally for safety, down 5 spots, while sitting as the 31st most expensive country to live in. That's an unusual combination, less safe than before, but still expensive. Their specific comparisons are compelling. Malaysia ranks 13th for safety, 2 spots ahead of Canada, and costs 46% less. And a tax treaty with Canada in place since 1976 makes it practical rather than just theoretical. Vietnam offers 58% lower costs and ranks 38th for safety, safer than both France and Thailand. The concrete illustration: 1 month of Toronto expenses could stretch 2 to 3 months in Vietnamese cities. That gap is the capital accumulation strategy, not a stock pick but a cost structure reset. The most structurally interesting case is Montenegro, 32% lower cost than Canada, with income tax rates between 9 and 15%. However, there's no Canadian tax treaty, which limits its appeal for active earners, but for retirees with investment income or digital nomads with location flexible income, it functions as a low tax base with European access. Taken together, Blueprint Financial's argument isn't leave Canada, it's that for some Canadians, geography is the highest return financial decision available right now. What's notable about today's analysis is that four independent creators looking at very different data sets are all pointing in a similar direction, and their pieces fit together into a single coherent narrative. Soretsky identified the structural crack: Canada's growth model depended on population and debt, and one of those inputs is just reversed. Eurodollar University showed that global markets are already repricing around recession risk, not inflation, even as central bankers make noise about hikes. The flight to safety trade is live, and the policy tools that worked last cycle may not fire this time. Into that backdrop, minority mindsets advice: own cash flowing assets, don't upgrade your lifestyle, let compounding do the work, is exactly the right posture for a slow growth, high uncertainty environment. The challenge is the capital requirement, and that's where Blueprint Financial closes the loop. For Canadians whose cost structure is making it impossible to build that capital base at home, geography itself becomes the financial lever. The through line is this: the era of effortless Canadian growth, cheap debt, rising population, appreciating real estate is over, and what replaces it requires more intentionality, whether it's how you invest, how you spend, or where you choose to live. Well, that's today's brief on Canadian macro. All credit goes to the creators featured today. Their original videos are linked in the description below, and I highly recommend checking them out for the full analysis. If you found this video helpful, please subscribe. Hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.